Friends, in this video for ithought Advisor, I am going to talk to you on the topic creating a response. The markets fell in May, the markets fell in June too. When the markets fell in May, it was driven more by FII selling and the impact was felt in a more narrow part of the market. But in June, we are seeing the impact spread, and recent days have seen a bloodbath in small caps. As an advisor or as a manager, it's very important to take stock and create an investment response in every investor's portfolio, because the quality of that response will play a significant part in long-term investment outcomes. Firstly, is a crash of this nature an opportunity or should you wait it out? This is the first dilemma in the minds of most investors. But as somebody who curates and manages portfolios, our dilemma is, are we finding our ideas very compelling? Are our return expectations in individual ideas going up significantly? If we find a positive response to these two questions, then we would not want to look at what is happening in the broader market and be very bottom up and stock specific or fund specific or theme specific. Looking at the Nifty gives us some sense of where the economy is now relative to where it was over the past 2-3 years. Clearly, within the Nifty, several companies are reporting their highest revenue and profits in several years, and they seem to be reasonably well poised to continue to grow into the next few years. So there is no uncertainty within the Nifty on several companies. The only issue was, are we valuing these companies at a higher level than what their growth can justify? Now, if you look at the fall of the past 2 months, that has got addressed reasonably well in my opinion. Today, we don't have that problem. That problem is out of the window as far as the Nifty stocks are concerned. So, if you are a large cap investor or if you have a large cap component of your portfolio which can be scaled up, this is probably a good time. I'm sure many of you will wonder whether the markets can go down further. That is something which nobody knows. But if the markets fall further and if sentiment remains weak, then one can be certain that that will be an opportunity to scale up the large cap part of your portfolio further, because there's a lot of headroom to do that. It's fairly a simple decision and an obvious one given the fundamentals of the large caps within the Nifty. They are at their best in many recent years. Now that we know that, investing in the Nifty or within the Nifty in large caps, in select themes makes a lot of sense now, and it will only make more sense going forward. If there is a further fall, then we need to look at the other parts of the market which are worrisome. Firstly, the mid-cap universe. In my opinion, the mid-cap universe has become way too restricted for my comfort. You cannot restrict that universe to just 150 stocks. And by doing that, I think we have destroyed the scope for innovation in that sector. Valuations have been high for an extended period of time. So there has been froth in mid-cap valuations for an extended period of time, and the companies which are heavily institutional owned have more froth. So the only time to buy mid-caps after this recent categorization is when they are down and out. So I think that time is still not before us. because liquidity still goes into that category and valuations are still holding up because domestic liquidity is probably going into that category. Now to the small caps. Most people think that small caps can give the highest profits, which is true of several small cap companies. But making a generic statement like that can be quite misleading. The reason is that in the last 1 year, whatever small cap returns you have seen has come by buying already expensive companies or portfolios of expensive companies and hoping that it will go up. Very few small cap companies have really traded at compelling valuations to buy. But slowly that tide is turning and more small cap companies are coming into the zone of valuation comfort. This means that we can invest in those companies going forward as each company comes into a zone of compelling valuations. Now, as an advisor or manager, what I feel and what my colleagues constantly debate is we must not wait for too long. We must undertake investment actions where we find compelling valuations. We can alter the pace of those actions. You can do them slower, but not making any investment actions is simply letting the opportunity pass. So, what we have been telling our investors is add 10% to your portfolio. We would be able to make very precise investment interventions in your portfolio in stocks or funds where the valuations are far more compelling now. Those interventions may be just adding 1% or 2% to that individual idea. Sometimes it can be as low as 0.5%. It all depends upon how we want to pace the scaling up of that idea and be ready to buy more if they become even more attractive. A very sagely investor I had lunch with last weekend told me, this is the time to invest in individual stocks like you send IV fluids into a body. He said it should be done at a pace which is very measured. I really like that analogy because that is how I would want to scale up individual stocks when they fall. And that is how we can control our portfolio metrics, control how we manage some notional losses that could come because of market volatility and ensure that our portfolio is built at attractive valuations. The valuations of the entire portfolio should be moderate so that when you see a better sentiment in the market, your portfolio will outperform the market significantly. So the investment actions undertaken now will matter and each investor should invest at least 10% more to his existing corpus to scale up the most compelling ideas in the market now. You may ask what happens to the ideas which you already own. Some of them may be fit cases for a small top-up. Some of them may be best allowed to just run. Case by case investment decision making is essential now because we don't have too much money and the money that we put in should go to the best opportunities. So, this is an opportunity where investors must participate. This is a market where we will find great companies trade at moderate valuations, at reasonable valuations, and participating now will make our overall investment performance superior over time. That in essence is what we feel every investor must do now, and that is what we would like to do for every investor. We want to be measured in our response. We want to achieve scale. We want to ensure that investors participate, and we don't want to let this good opportunity pass. Thank you for watching this video.